recording here. Okay.
Okay. Here we go again. So hi, everyone. Welcome to another edition of the Microstructure Exchange. I'm very happy today that we have my colleague Marius Zoican here to present on liquidity fragmentation on decentralized exchanges. As usual, you know the rules and you know the process. We can have clarifying questions and we have a discussion at the end. Marius, the floor is yours.
Thanks, Andres, and thank you for having me. This is actually the first time I'm presenting this paper. It's a joint work with Alfred Lehar from Calgary and Christine Parlour from Berkeley, and we found it very exciting. So first, what are decentralized exchanges? Because that's probably not at the forefront of people's mind. They're essentially a type of market design where traders can interact directly with the matching engine, which is just a piece of code or a smart contract that lives on the blockchain. So basically, you're interacting directly with the market. That has some benefits relative to centralized exchanges, at least the way they are in crypto. It means there are essentially no Sam Bankman-Fried to take away your assets. You keep custody of your assets. You're just trading directly with the matching engine. Is more secure because in order to hack the decentralized exchange, you have to hack the entire blockchain. But on the flip side, because these markets live essentially entirely on chain, the process of trading can be a bit slow and clunky, right? Because trades will settle only every 5 seconds on the Ethereum blockchain. There are network costs. You have to pay gas fees on the blockchain, and to do that, a lot of these exchanges operate like a very parsimonious design that encourages you to interact as least as possible with the exchange, right? Compared to centralized limit order books like Binance would have, where it's very fast because it's essentially like a limit order book. Nevertheless, decentralized exchanges have become more popular since the end of 2020. They trade over $100 billion every month, and sometimes they exceed even 200 in 2021, 2022. Trading has tapered down a bit lately. The crypto winter, the crypto prices are not very attractive anymore. And across decentralized exchanges, there's one that stands out that trades the most, and that's Uniswap, and that's essentially the one we're going to look at the data for. And decentralized exchanges represent a fair share of all the crypto trading volume, around 20%, right? So they are economically important. So what we're going to be focusing is this promise of passive liquidity provision. Because the trading mechanism is clunky, what decentralized exchanges want to do is allow liquidity providers to have a hands-off approach to the way they're providing liquidity. They don't have to interact with the market very often, which should be particularly valuable for small liquidity providers, for retail traders. Think of this as sort of like the ETF set it and forget it approach to liquidity provision. So I'm going to give you a very quick primer on how liquidity provision works on decentralized exchanges. Let's say you want to provide liquidity, you're an LP. You, in a pair like Ether against the numeraire. I wrote here very clunkily the numeraire to be Canadian dollar. There's no Canadian dollar token, but let's assume there is. You will actually have to deposit both assets. You'll have to deposit Ether and you'll have to deposit the numeraire. You're essentially putting them on the market in what's called a liquidity pool. And these deposits, I found it useful to think about them. They are, in a way, equivalent to ask and bid quotes, right? So you put one Ether on the pool. That's a commitment to sell it if anybody wants to buy it. So it's sort of like an ask quote on a limit order book. And you put the numeraire, which is essentially committed to buy Ether with it if somebody wants to come, and that's economically equivalent to a large extent to a bid quote on a limit order book. So you have to, and in 99% of the cases, you will put both tokens at the same time. Now, assume somebody comes with an aggressive order, an aggressive Ether sell. That's going to be called a swap. They are going to essentially deposit the Ether into the pool and remove your 2,700 Canadian dollars. So they're basically going to swap one currency for the other. And they have to pay a liquidity fee to the liquidity provider. So that's a compensation for providing liquidity. And you can think of this as sort of equivalent to a tick size on the market. And a lot of the literature so far has focused on how this price is being set, right? So here's a deposit 1 Ether and 2.7K Canadian dollars. There are actually rules that sort of constrain what proportions you need to deposit this, and that's part of the automated market maker. That's not going to be the focus of this paper. The focus of this paper is literally the decision on how actively to manage liquidity and on which market, on which tick size to put it on. So we're going to abstract from this price event. Now, after this market order completes, the liquidity provider will have 2 Ether, the one that you originally put, and the one that they traded, the one that they bought, and they will basically have no units of numeraire. And perhaps this is a suboptimal position, right? Because you're no longer doing a two-sided market, you're doing a one-sided market that exposes you a bit more to price risk, so you might want to rebalance. But if you believe the order flow is balanced and there's a buy and a sell and a buy and a sell and so forth, if the next trade is going to be an Ether buy, that's going to take the Ether and put back the Canadian dollar. So you're going to end up pretty much in the same position that you started for. So what's the interesting thing here is that DEXs are essentially designed for passive liquidity provision, right? The quotes are never fully consumed. They're not fully executed. They just transform. You transform one currency into the other, and then the opposite trade might transform it back. So in theory, you can just cash in the fees and interact very rarely, if ever, with the market, right? So it's designed to be very passive. Liquidity is never removed, it's just transformed. And this is by design. And one major reason for the design is that you want the DEXs to be parsimonious because interacting with decentralized exchanges is costly in terms of gas cost. I mean, as the systems evolve, potentially gas costs are going to go down, or they're going to go down to zero. So that's not going to be the relevant friction. But there's still going to be fixed costs associated with liquidity provision for small traders, for retail traders, right? There's the time cost, there's an effort to understand what the market is. And what DEX is, what this mechanism sort of promises is a set it and forget it approach. And you just passively collect fees from liquidity provision. So what we find in this paper is that there actually doesn't work quite as promised. We find that there are clienteles and passive and active liquidity providers will self-select in markets with essentially different tick sizes. And passive liquidity providers, although they represent the majority of liquidity provision, they actually don't get the commensurate share, the proportional share of the vol. They put on a lot of money and they get to trade very little compared to the money they put it on. So that suggests that there are some sort of inefficiency, and the active liquidity providers still come out on top of these markets. Now there is a recent and very rapidly growing literature on DEXs. All right, my co-authors have a paper on showing exactly that the liquidity provision is quite passive. Andreas has a number of papers focusing on automated market makers. It's expanding very fast. But in our opinion, we're the first ones to look at the actual liquidity provision decision. We also relate to literature on market fragmentation because we're going to study how liquidity fragments. and the role of tick sizes. And actually, we're going to be very close to this Foucault, Kadan, and Campbell paper in the JF, applied most of liquidity cycles, applied mostly to operator set. So before I go into the model, I just want to sort of show you the main puzzle that made us think more about these clientele effects. So we saw that Uniswap is the leading decentralized exchanges. And on the most recent iteration of Uniswap, you can trade each pair, like Ether against I don't know, USDT or USDC. You can trade it on up to 4 different independent markets, which are called liquidity pools. And these markets differ from each other by their liquidity, which can be either 1 basis point, 5 basis points, 30 basis points, or 100 basis points. So these fees are paid by the aggressive order to the liquidity provider. And when they first launched the protocol, what the Uniswap founders thought is that, well, for every particular pair, trading is going to be focused, trading and liquidity is going to be focused in one pair with a liquidity fee, with a liquidity compensation that's proportional to the volume. In practice, what we find is considerable fragmentation, especially for big pairs, for large pairs, right? Like the most traded pair tend to trade on multiple liquidity pools at the same time with different fees, and that itself is puzzling. Why doesn't trade just sort of bubble up into one market? For any particular pair, most of the trading volume happens in the low fee pool, and that makes a lot of sense. Right? It's consistent with optimal order routing. If I have to send an order, I will obviously send it first to the market where I have to pay the lower fee to the liquidity providers. And because liquidity providers are competitive, they would go where the trades are, so they should also converge to the low fee pool. What we find instead, and I think this is the puzzling fact, that for a given pair, there's actually a larger stock of liquidity at any given time in the high fee pool. So you can think that there is the deeper market is not the market with the most volume. And we're wondering, why is this the case? Why we have this difference that one market has the liquidity and one market has the trading volume? What came to mind is obviously a clientele effect type of story. So I'm going to have a model sort of trying to explain this pattern. This model, we're going to generate additional predictions, and then we're going to test them. There's perhaps a natural point to take any questions, or should I just jump straight into the model?
So I don't see any questions in the chat, but let me ask you a question straight away. So the suggestion of fragmentation means that you have to pick the pool in which you trade. But in standard practice for, say, Uniswap, which is what you're really looking at, is that there's an auto router which picks the pools for you, and they start routing always to the pool which is the cheapest, and then they go through the different pools as they become more expensive. So in other words, if you really want, you can think about this merely as a limit order book, and you're saying that people who are more worried about, say, adverse selection post further off, they require higher fee compensation, right? Because ultimately the fee that you charge is the principle of the spread. And that seems completely natural. I don't understand why you would refer to this as fragmentation when there is an auto integration.
Well, the reason why we think of this as fragmentation is that we actually see that there are clientele effects. Like the orders that end up on the high fee pool, they seem to come from different types of liquidity providers. I see what you have in mind, and it is as if these orders are sort of posted deeper in the book, in some sense. They will have a lower execution priority, and basically that compensated with. So
I have some questions here. Barbara asks, how are the fees tick set in the different pools?
So there is a standard menu of pools that Uniswap offers: 1, 5, 30, 100 basis points. And basically everybody can, or anybody can create a market with this one of these fees. It is no longer existent. So the creation of the pool is entirely endogenous. Most of the time, for the active pairs, there are markets in the 5 and 30 basis points. For pairs against pairs with very little volatility, like stablecoin against stablecoin, that are just supposed to track the currency, you sometimes find 1 and 5 basis pool. But for most of them, it's either 5 or 30. Can you see that the same wallet ID? I see a
So
question.
if I may jump in for 1 second, I thought maybe Barbara also wants to probably know the fee levels. The fee levels are set by the protocol, and the protocol sets them according to a vote of the token holders. So there are votes on what kind of pools should be established, and at what fee levels. Just for further background, maybe that's useful. So these are not picked by the individual, or if somebody wants to create a pool, it's just a way how the contracts or how the system works. So sorry, then maybe Olga's question. Sorry, Marius.
You see that the same wallet ID provides liquidity on both high and low fee pools. We haven't looked explicitly at wallet by wallet fragmentation. But we do see that on average, the wallets that provide in liquidity on the low fee pool are quite different than the ones on the high fee pool. But it's a good suggestion. We can do an analysis on a wallet level. But that's a good point.
Okay, maybe you want to continue then.
Okay, well, let me get into the model. So it's a very simple model. We only have one asset, one token that is traded, expected value V, and it trades on 2 pools with exogenous fees. H is going to be the high fee pool, L is going to be the low fee pool. And we're going to have a mass of liquidity providers. They're going to be risk neutral, which doesn't really matter since there's no risk to begin with. But they have heterogeneous token endowments. Basically, there are small liquidity providers and large liquidity providers, and the token endowments follow a bounded Pareto distribution. So we wanted to replicate a pattern like this. Many wallets that are relatively small, so think of this as a large mass of retail traders, of retail liquidity providers, and then a relatively small mass of big institutional funds that would like to provide liquidity. So we wanted to create this heterogeneity in liquidity provision. And on the other side of the market, there are liquidity traders, and they come in 2 flavors. There can be small liquidity traders. So those people arrive as a constant flow, arrive as a constant rate, small theta per unit of time, and they would optimally go to the low fee pool first. It's as if they have basically the auto router. They will get routed immediately to the low fee pool if the low fee pool has enough liquidity, but because these guys are small, almost surely the pool will have enough liquidity. And from time to time, there are large liquidity traders that arrive. They demand a large unit of tokens, so enough to basically wipe out liquidity on both markets, and they arrive as a Poisson process with intensity lambda. Right, so you can write the process for the liquidity demand is basically the sum of the small liquidity traders that arrive constantly plus from time to time a large event. And finally, we have a measure of gas costs. All right, so any interaction with the pool, regardless of the size of the trade, you have to pay a fixed cost, that's the cost of interacting with the blockchain, or perhaps the opportunity cost of the time to manage your liquidity, gamma larger than 0. For the liquidity traders, we assume they have a high enough private valuation for the asset that they're always happy to pay these costs. For the liquidity provider, this is going to matter more. So essentially, this model can be cast as a model of liquidity cycles. It starts with liquidity providers basically choosing one pool, either the low or the high fee pool. And then on the low fee pool, you're going to have this constant flow of traders, basically just consuming the liquidity. And when they basically transform your liquidity completely, that's the end of the liquidity cycle. And that's when you want to rebalance and you start anew. Or you can have a liquidity cycle where a large liquidity trader arrives. The large liquidity trader consumes liquidity on both the low and the high fee pool. So that restarts the liquidity cycle again across both pools, right? So you basically have faster liquidity turnover on the low fee pool because that's where all the small guys come, and slower liquidity cycles on the high fee pool because that's only ends when you have the large FTs. So what's the problem that we're trying to solve? Liquidity providers, they will choose a pool to maximize their expected profit per unit of time. So that's basically their endowment times the liquidity fee that they're getting. And at the end of every cycle, once their entire liquidity is consumed, they have to pay the rebalancing cost. They have to pay the fixed cost. Yeah, we think of it empirically as a gas cost, but you can think of it as any other fixed cost of tinkering with the market. And what's endogenous here is the duration of the liquidity cycle. And the duration of the liquidity cycle depends on how many other liquidity providers have made the same decision as you did, right? For the high fee pool, this is simple. The high fee pool only exhausts when the large liquidity trader arrives. So the duration is simply 1/λ. Low fee pools, they have shorter cycles. They also end whenever the large liquidity trader arrives, but they might also end earlier if enough small liquidity traders arrive at the market. And basically they deplete the stock of liquidity, this LL, right? Which is basically the aggregate endowment of everybody choosing the L pool. So the marginal liquidity provider is indifferent between the two pools, right? And their endowment is proportional to the gas fee. So what's the trade-off? If you choose the low fee pool, then essentially you're getting to interact with more volume because that's where all the small trades are coming, but you have to rebalance more often. So you have to pay the fixed cost more often. Whereas if you choose the high fee pool, you're getting a higher fee per unit of trade. You're getting low priority, right? You're basically at the back of the queue, and you're only interacting with the large traders when they arrive. And on the other hand, you have to rebalance less often. So we're going to see that basically traders that value this fixed cost differently are going to sort themselves in the different pools, right? So how would the equilibrium look like? Will we get fragmentation, or we get people that choose different pools? If the gas costs are very low, then the rebalancing is not binding for anybody. It's not very costly for anybody. So then competition between liquidity providers will push everybody to the low fee pool. Everybody wants to provide liquidity to both small and large liquidity traders. For very large gas costs, if rebalancing is very expensive, then everybody will go to the high fee pool just to collect the higher fee to allow them to cover their costs. For any value in between, you basically have fragmentation. Some liquidity providers will go to the low fee pool, some liquidity providers will go to the high fee pool, and they will sort themselves out. So this is how the clienteles look like in equilibrium. There's going to be a mass, or there could be a mass, and not needed to be a mass of very small liquidity providers for whom the gas prices are very expensive, and they are going to stay out of the market. They don't have to provide liquidity. Then the smaller liquidity providers are going to go to the high fee pool because they want to avoid rebalancing very often. And the liquidity providers with a very large endowment, for whom the fixed costs are relatively small, they're going to compete on the low fee pool. So they're going to provide liquidity where most of the trading actually happens. So what we should see in an equilibrium, what's a prediction, is that the average endowment, the average liquidity deposit on the low fee pool is higher. It comes from these guys, from the guys with a large endowment, than on the high fee pool. And under these assumptions of the Pareto distribution, we expect to see more small liquidity providers on the high fee pool and fewer large liquidity providers on the low fee pool. And we get basically the puzzle, right? We see that the volume is going to be much larger on the low fee pool because you have both small and large traders, and the average trade size would be higher on the high fee pool because you're only getting the large people coming in. All right. Now, what's the role of gas costs? What we're doing in the model, we're doing some comparative statistics on what happens with market shares of various pools when the magnitude of the fixed cost changes. So as the gas cost increases, right? The gas cost is very low, then everybody goes to the low fee pool because rebalancing is not expensive. If the gas cost starts to increase, then we see a substitution effect. We see people migrating from the high fee pool, from the low fee pool to the high fee pool. So basically the marginal trader here switches over to the right. So we see more people coming on the high fee pool, leaving the low fee pool and moving on the high fee pool. If the gas costs increase even further, then we see that more and more people are getting crowded out, right? So the liquidity mass, right, the size of the liquidity pool on both the low and the high fee starts dropping. All of this results in having a higher market share, as gas costs are lower, a higher market share for liquidity pool H, and conversely a lower market share for liquidity pool L, right? So we have a substitution effect where they're just the same guys sort of migrating from one pool to the other, and the crowding out effect where the smaller LPs are just being kicked out of the market. And this effect only comes in when the gas cost is large enough. But this gives us some sort of testable prediction on what should happen with market shares if we have time variation in gas fees. All right, I guess that's a natural point to take more questions before I jump into the data.
So we have a question from Peter. Peter asks, why then wouldn't the low field pools adjust the priority setting algorithms to get more volume?
So the low fee pools are the ones that actually have the most of the volume. It's only the sort of the large traders that will go to the high fee pool, and everything here is pro rata. So every trade that comes and trades against the massive liquidity providers, all the fees are split in a pro rata fashion against there's no time priority on these markets. And I'm not sure these rules can be changed very easily. I'm not sure what would happen if we had time priority. But the low fee pools actually have most of the volume. They don't have a lot of the liquidity stock. What we'll see is that they have a lot of liquidity turnover. Like people update very frequently, but most of the mass of the liquidity, the money, the passive money is in the high fee pools, and they don't trade a lot.
So Okay. Jason asks, what would happen if the small liquidity providers, I think, or is it liquidity traders, are allowed to freely choose both low and high field pool in your model? Oh, right. Probably the small traders that come in.
I'm not sure if that would be optimal to split your trade, because then you have to if you get out of range, if you need to rebalance, then you need to rebalance on both pools. You'll have to pay twice the gas fees. So it's probably more economically to just pick one of them. It's optimal to just pick one pool. And also, like, if you're small and you're going to the low fee pool and you're competing with all these large liquidity providers, because the markets are clearing in a pro rata fashion, you're actually getting a very low share of the fees to begin with.
So, okay. Here's a question about adverse selection. Actually, the question I also want to ask. So Olga asked, aren't liquidity providers in the high fee pools more frequently adversely selected as they do not reposition as frequently?
I think that's very likely. We don't look directly at this. We probably should. But I think that's a very likely outcome, and that's why they're getting the higher fee as an extra compensation. But if you think of this just worsens the problem, because you have these small liquidity providers, potentially retail liquidity providers, that want to be passive, and not only they don't get their fair share of the volume, but they also get higher adverse selection costs. So what you're saying is very plausible, and we should probably look into this as a next step. It will just make the problem we're studying even worse for the small liquidity providers. That makes sense.
Well, I think there is a general question here is as the price moves, or as the fundamental moves, if you want, right? So if you are at the low fee and you trade a lot, you have a lot of amplitude, which as it is usually adds, which usually cancels out. So you get to collect the pure fee. So it seems to be that there is you have your horizons that you deposit in, and I think there is the risk factor that you have of being adversely selected, or the fundamental moving is different over these different horizons. It could be two answers to look for. One could be risk aversion. The other one could be just the compensation over time. So not sure if I'm making that very clear, but the point is that when you have low amplitude trades, there's very little that you have in terms of price movements that you're adversely selected to.
Yeah, that's possible.
Yeah, are there any other questions? And I see nothing in the chat. If not, then Marius, maybe you just move on to your empirical findings.
Right. So we look at data on basically all the Uniswap entry, trades, liquidity deposits, withdrawals. We get this data from Kaiko because it's very nicely prepackaged for us, from essentially the inception of the pools from May 4, 2021 until essentially the day of the merge, when Ether switched from proof of work to proof of stake. That's September 15 last year, and we can see basically all the wallet addresses. Right, that's not necessarily a trader can use multiple wallets, but this is a first approximation. We are converting everything into US dollars to sort of have a common basis of comparison using the Kaiko's cross price API. Basically, we're looking at minute by minute pricing to convert all the token prices into USD. We also need a measure for gas costs, and there are a lot of interactions with the Ether blockchain, so we want to have a good proxy for gas costs associated with liquidity provision. So we're taking the average of the lowest daily 100 prices for mints for liquidity provision events, right? Because we want this to be basically the marginal gas cost, the cheaper it can be in a given day. And then There are a lot of tokens trading on Uniswap, many of which are, joke tokens. They're not trading a lot. They don't have a lot of economic importance. So we have to sort of weed out and focus on the economically large pools. So we impose a number of filters. We want the pool to be active in more than 30 days throughout this 1.5 year period. We wanted to have at least 100 liquidity events. We want to end the day on average above $100,000 liquidity pool size. And we exclude pools that capture less than 1% of volume. So we end up with 262 pools in 224 asset pairs. That account for almost 90% of all the interaction on Uniswap Be3. They will have an aggregate daily volume of $1.32 billion. And at the end of the sample, the aggregate liquidity in all of these pools is over $3 billion. So that's a pretty large amount. So we do see evidence on clienteles. If we look at the average liquidity deposit, it's significantly larger on the lower fee pools than the higher fee pools. So it does seem that the large liquidity providers tend to go to the low fee markets, and the small liquidity providers tend to go to the high fee markets. The average trade size is much higher on the high fee markets. So again, that's consistent with the model we had at the low fee markets attract many small trades that are being routed there, whereas the high fee pools only attract large trades that cannot find the liquidity on the low fee pools. There are many more, especially in the tail, there are many more traders on the high fee pools, even though they trade much less on a daily basis. All right, so we obviously do some regressions on our data, and we confirm that low fee pools have these are all in log insight. So this is the 90% effect actually in absolute terms, 90% larger liquidity deposits, lower trade sizes. On average, they have twice the volume. The low fee pools have twice the volume of the high fee pools. They execute many more trades, and they have fewer liquidity providers. To a range like 30% fewer liquidity providers on the low fee pool. So that's all consistent with the model. Now the question is whether this effect is driven indeed by the fixed costs. So to do that, we're looking basically at the time variation in gas prices and the liquidity and volume market share. So first, we sort of reconfirm that there is this mismatch between liquidity and volume market shares. The low fee markets have 12 percentage points lower market share than in liquidity terms than the high fee pools, but they trade 30% more. And the effect seems to be driven, at least partially, by the time variation in gas prices. Like if I increase the gas price by 1 standard deviation, that's going to widen the liquidity market share gap by 2.3 percentage points. There is an effect also for trading volume, but it's much weaker. We want to think of this as the fact that, as we saw, trading volume is relatively inelastic to gas prices. That's how we model the liquidity traders. They don't really react to gas prices. They just go wherever it's cheaper, and there is an effect just driven by the change in liquidity, but it's much weaker. We see that when the gas price is larger, we have 1 standard deviation higher gas prices. We see 36 fewer daily mints. Sorry, 36% is in logs. 36% lower daily mints on the low fee pool. All right, so it seems that people start avoiding the low fee markets. We don't see an effect on the high fee pools. The high fee pools don't seem to be affected by liquidity provision doesn't seem to be affected that much by changes in gas prices, which is again consistent with how we think about the model. High gas prices mean people migrate from the low fee pool to the high fee pool, and that's why we see a little bit of a positive effect, whereas some people might be crowded out of the market, right, from the high fee pool. So on the high fee pool, the effect is not clear. You have people migrating from the low fee pool, people going out. So we on aggregate, we don't see an effect, but they seem to provide much less liquidity on the low fee pool when the gas price is high. The probability of seeing at least one liquidity deposit on any given day decreases by 7 percentage points if the gas fees are higher on the low fee pools. It also decreases to a much lower extent on the high fee pools. And this again is consistent with the story. We see fewer mints, but because there doesn't seem to be an effect on the aggregate amount of liquidity minted, these fewer mints tend to come from larger liquidity providers that potentially are migrating from the low fee pools. So this is consistent with the sort of change in liquidity clientele, with the shift in liquidity clienteles when the gas prices are high. And finally, we want to look directly at the length of the liquidity cycles, right? Because our paper makes a very sharp prediction on the fact that liquidity cycles should be faster, should be shorter on the low fee pools, and they should react again also to gas prices. So the time elapsed from minting, from depositing liquidity to removing it, to rebalancing it, is for both high and low fee pools, right, on average is around 50, 60 hours, right? So it takes 2 or 3 days on average to, which is passive, and it has a very long tail. So you can see that liquidity cycles are much shorter on the low fee pools than the high fee pools. Again, consistent with our model. The time elapsed from the moment you sort of remove the previous liquidity until you post the new one, but basically your rebalancing time, you can see it's much faster, right? It can be measured in basically the average is 5-6 minutes, and even at the tail, it doesn't take more than a few hours, right? So this is a different order of magnitude. So what happens here is that people deposit liquidity, they wait until their liquidity is depleted or it sort of moves out of range. That means that they basically end up with one token rather than making like a two-sided market. And the probability that they are out of range when they rebalance is 70-80%. So that's what they're really doing. They're minting, they're waiting for the liquidity to be depleted, and then they're rebalancing. And when they're rebalancing rather fast. It does seem to be like a substantial difference in liquidity cycles. How is this affected by gas prices? Well, you can see that if gas price is high, the liquidity cycle on the low fee pool actually gets shorter, right? And this is because people migrate from the low fee pool to the high fee pool. So there is lower liquidity, and under the assumption that trades are relatively insensitive to the gas costs, basically liquidity demand faces a smaller liquidity supply, so the liquidity depletes faster. So the time to rebalance will actually go down. You don't see so much of an effect on the high fee pools, right? Because of the high fee pools, the liquidity is sort of constant. You don't see this migration. And just to sort of have in mind that there is nothing here that's necessarily driven by how people act in general or interact with these platforms in general when the gas prices are high. We also look at the time between the time you withdraw liquidity and you mint it again. So basically that's your rebalancing time. That doesn't seem to be affected very much by the gas prices. So it's not that people just act differently in high gas environments. It's mostly the fact that the liquidity pool is smaller, so it depletes faster. So that goes into the direction of what we had in mind. So I think I'm pretty much right on time. So let me conclude. One of the promises of decentralized exchanges is that it allows passive liquidity provision, right? In the same way that ETFs allow passive investment to small traders. So it will democratize liquidity provision. This was done by design to sort of save on gas costs, because interacting with blockchain-based exchange is expensive. It could encourage smaller traders to participate at market makers. So that's the promise. What we find is that the existence of these fixed costs in markets, they lead to different economies of scale for different types of liquidity providers, which actually mean that smaller liquidity providers are, to some extent, not getting their fair share of trading volume. And we see in the data, we see this emergence of clienteles between very active low-fee pools, which is the playground for big, we would say, institutional liquidity providers, few large ones with faster turnover, faster churn of liquidity, short cycles, and constant refilling. These will have a lot of volume, but at any given time, they will have a lower depth because the depth gets rolled over. And we have the sort of passive high fee pools. This is where the retail trader would go. They will have low volume. They will only trade against the biggest trades, which, as Olga said, could be the ones that are that contain the more information. They will get a higher fee. They will have to rebalance less often. But in the end, there's a lot of idle money sitting there on these pools that is not getting commensurate trading volume. And that's what I had. I'm happy to take questions for now. Thank you.
Well, thank you so much, Marius. And let's go start the discussion. So let me start off because I don't see anything in the chat. So you're making a judgment statement there. You're saying that the liquidity providers that put money into the high fee pools are not getting their fair share. But you could at least compute this, right? So as the price moves, when they trade, they have they have an adverse selection loss of some form, right? So that's intrinsic to the buy and hold strategy, and they get compensation from the fees. So you should be able to compute whether or not somebody who makes a deposit at that time would actually be making a loss or a gain. So that's the first thing I want to say. And then I have another question which relates to just the interpretation also of the liquidity provision in the low field pool. Now, the first thing I note is that despite the fact that you say the liquidity is there for shorter periods of time, it's much longer than what we see in regular markets, right? And then the second point there is there maybe an interpretation that you could have, because you can set this price range essentially in such a way that you're trading only for, say, increasing prices or the like. So maybe an interpretation of that pool would also be that somebody trades with essentially limit order, right? So they're essentially just trying to buy, and they are trying to stay there just for the amount of time that it takes for the price moving their way.
On the low fee pool, you mean?
In the low fee pool, yes.
Yeah.
Particular. But sorry, maybe the first question first about before you make the judgment call, is there a way how you can actually have you looked at specifying what people actually would earn on these pools relative to the adverse selection loss that they might face as the price moves around them?
Yeah, I think that would be a natural next step for what we're doing. For now, we're just comparing basically the volume that they're executing against the liquidity share that they're having, and we see that there is this big mismatch. Like the deep markets have low volume and vice versa. But you're right, we can take this to an analysis, like a wallet by wallet analysis, in which we take into account the fact that these markets have indeed a higher fee, and try to sort of estimate their other costs of liquidity provision, like adverse selection, like what you and Olga were suggesting. And then we can look at the returns of the two groups. That's a fair point.
Because within the context of your model, in the model, everybody acts optimally, right? And so unless you find evidence that people are, that there's some lack of optimality, that there's they operate under an assumption that is not warranted, there's really not much, in the negative sense here, right? It's just what people want. Sorry, I don't want to hog the conversation. I want to, see if other people have something to say.
Albert.
Yeah, this is, I've always enjoyed listening to the people trying to make sense of decentralized exchanges. And I get bits and pieces all the time. And of course, since you've been thinking about this, Marius, with your co-authors for a while now, you must have been thinking, like, what is the relative pros and cons of this market structure relative to the market structure that we know for all traditional assets? And so it seems like in a traditional market, I could post all my equities, and then people take out one equity for the other. And if some equity gets in short supply, I replenish it from somewhere else, and I make my equities available. And therefore, every time somebody takes or swaps something, then I get a little fee. And that's the way I'm trying to project everything you've been telling me onto, how that could work for traditional assets. Now there must be pros and cons. And have you thought about what they are, and in particular, is it natural that this market structure is really occurring endogenously for crypto assets, because there's something different about crypto assets relative to the traditional market structures are the natural ones to trade traditional assets? I know this is a bit tall question, but help me. It would be wonderful to get a little bit more sense of why this is trading, why over here we trade this particular asset this way, and over here we trade the other asset that way for many decades now.
That's a great question. Like in the context of crypto, the main advantage is security and custody, because you don't give your assets away to some potentially non-regulated exchange. From the broader sense, the goal is disintermediation, because now with traditional exchanges, they have a lot of market power, for example, in setting data fees.
But Marius, I'm not giving my assets away to exchanges when I trade the traditional way, because they're still in some with a custodian somewhere. And oftentimes it's a clearing organization that then moves it a few days later. So it's not as if whatever we built and been using for decades is unsafe. Or I have trouble believing that.
It is safe, but it requires sharing the value along this chain with the CCPs, with the exchanges. Like, they're all taking a cut, and they all need to be heavily regulated in this sense. And away from this, from the custody issue, exchanges are also having a monopoly on their data, right? Even with the SEP, there is still a lot of money that you need to pay the exchanges to get more granular data. What decentralized exchanges promise, well, everybody can interact directly with the matching engine. Everybody understands how the matching engine works. You get to see everything granular. That's why they're, because you lack this sort of user-friendly interface, they're a bit clunky to use. Like, there's a steep learning curve in the beginning, but they take away the problem of potentially extracting rents from the process. particularly on the data side. And then the aspect that we're studying in this paper, you're allowing small liquidity providers to basically have this passive strategy, which is not right there. Like if you want to actively sort of like make markets, like an HFT would on a traditional securities market, you will probably need to monitor your quotes constantly, and you will need to code the algo. Whereas here, the algo is built in for you.
Okay.
So I have an opinion too, if I
Thank
may push it out there. So first, I think actually one thing is just to your point, Peter, is that changing liquidity doesn't affect the price. That's very important for these markets, and these markets are continuous. So that's another thing. Now, to Albert's point, a blockchain is essentially the place where you have your value, right? Where you hold your assets. And if you need to use a decentralized exchange like Binance, you actually have to transfer them out. So it kind of seems counterintuitive that you build a decentralized value management infrastructure and then do trading elsewhere. Now, you can trade in a limit order book in a decentralized way too. There's two ways to do this. There's a very bad way, which is very, very inefficient, because every limit order that you use would be involving fees. It's just the way how the blockchain works. There are ways around this with rollups. So that's a different alternative mechanism, which is entirely decentralized and does not have the custody issue. That is, you actually keep control over the assets. And so I think that the reason why we see the AMMs is to solve the problem of you can't have a limit order book really on a mainnet exchange because it's too expensive. On the mainnet blockchain, it's too expensive to run. So it's a workaround in a way. So if that makes sense. There's nothing to take away from Marius's points, but I think there's a technological reason first and foremost of where this came from. And now the last thing I want to say is that crypto assets can be used in many other ways, and they are not necessarily investable items, and people have to exchange them for a variety of reasons, including use. And in addition to the Uniswap that we see these mechanisms that are used, the AMM mechanisms used in situations where people actually want to use the assets. So they have to swap to use an asset from one to another, and it's not a trade that they do in a sense of speculation. But okay, I shut up now. Pete, go ahead.
Yeah, I wanted to follow up on your comment. So if it's expensive to use the blockchain to do market making and you need what you call a workaround, how is a typical wannabe market maker going to verify that the workaround is as secure as the blockchain? We've seen multiple exchanges collapse, crypto exchanges collapse recently, and I'm sure you're going to tell me they weren't really decentralized. But how does an ignorant retail client determine whether it's secure or not?
Yeah, asking Marius or me?
Yeah,
Either one of you. So from Marius.
I mean the ones that collapsed, they were definitely not decentralized, because there was really this issue of custody, of giving your money to exchange, and they're not regulated properly or regulated at all. And then you get to lose your money. A proper decentralized exchange that works on the blockchain, in theory, you can see your funds at all times. You can see what smart contract they're on, and you can take them out at any point. It's just accessing a piece of code.
But how does a retail investor access the piece of code without going through some kind of intermediary, which might be a web page or something like that, in which case the retail investor has to verify that that intermediary is just as secure as the blockchain?
That's a fair point. So you have to use a website, and the website.
Well, the website, as far as I'm concerned, just an exchange, and the website could steal all your money, unless you have the technology to verify that it's not going to do that. But I'm not aware of such a technology.
Maybe I can answer that question very quickly. So I think this is fundamentally different technology. So a decentralized exchange is essentially a little computer program that runs on a blockchain that handles the exchange. And you just use a verified website from Uniswap to create the transaction for you, to put the little kind of computer program together that allows you to interact with that exchange. But essentially then you approve in your wallet that you want to go ahead with this. So your wallet software says, oh, you want to trade this on Uniswap, do you agree, yes or no? And so you have full control, versus something like FTX is a totally different system. So this is where people trade off chain. So essentially you give all your money and your tokens to an off blockchain entity, and then all they do when you trade there is they update the internal ledger, and nobody knows what's in that internal ledger. It's not on chain, it's not verifiable. So it's two very different systems, and it is obvious that to a retail user also what kind of that they work in a very different way.
Okay, but my summary of what you just said is that Uniswap is a broker and FTX was a principal, and that brokers are less transparent than principals. But how does a retail trader need to trust Uniswap? Do they need to audit Uniswap's code? Is Uniswap a blockchain? How does a retail trader tell?
So Uniswap is audited, and it is a very simple program, and it has no option to steal away your money, and that program cannot be modified by anybody anymore. So if a computer code doesn't have an option to take money away from you, it cannot. And so versus something like FTX, which is off-chain, is very unclear what they do. They can do anything they want, right? It's
Okay,
not
but if you're the
verifiable.
retail trader, you're not auditing the code, you're trusting the auditor.
Yes,
Is
to
audited
some
code.
degree, yes.
Yeah, I think
So-
Pete's comment is very well taken in the sense of there's still a level of trust involved. For instance, you need to make sure that the website that you're navigating to is not compromised in any form, right? And you need to trust, and to your point, Alfred, is you need to trust the auditor, right? So that Quantstamp that actually looked at the code has done this correctly. And of course, I mean, the code is public knowledge, right? So there will be more than one entity that will check the code. So that's a fair statement. There is no authority, as you say correctly, Kyle, like a regulator who has looked at the code and the functioning prior to it being released. And there is nobody to make you good if for whatever reason something breaks. That is just a fact of how this works.
Right.
Yeah, so Andreas, you're basically saying Uniswap is like Linux. It's if people,
Yes.
if the code is public, people look at it, auditors kind of study whether there are ways to cheat and inject malicious code into it. We know it's not perfectly safe, but we know it's somewhat safe. But it's not trusting something that's inherently not really trustworthy, because I don't think Gödel's theorem allows us to prove that Uniswap is completely trustworthy, right? Because it's got probably the ability to do arithmetic. If it's got the ability to do arithmetic, we can't prove it safe.
Well, once the code is released on the blockchain and it's there and it's unchanged, there are, so the way it can be changed, it would have to be built in a feature to make it changeable, right? And so that's a choice that will be visible, essentially, right? So there are codes, smart contract codes that can be controlled by a private key, essentially, or by a pair or by a set of private keys, and there are those that cannot be controlled and changed. So. And there's a reason why they could and could not be changed. So for instance, there is some automated features built in for changes. This is in the whole process of the so-called DAO governance, where people can vote and change, for instance, the fees associated with it. And so it doesn't require a person, and sometimes requires a person to do it, in which case there's an attack vector at hand, as you correctly point out, Keith. So it's a different setup. Then I would say it's slightly different from what we're used to, but it doesn't mean that all the problems go away. Right?
But
It
it's
doesn't
much more
sound different. It doesn't sound different from what people are used to. People are used to going to a website, saying a prayer, trusting the website, and then committing all their money to the website. that's the way business is done nowadays. Normal business.
It's much more transparent, I guess, and you know, at the margin, if there was a way to exploit it, some smart people would have found it and either exploited it or pointed it out. And you know, in any case, if I deposit on Uniswap and I go to the website and I want to burn and I want to remove my money and it doesn't allow me, there's always a backdoor. I can interact directly with the code. I can ask ChatGPT to write me a code to interact with the smart contract directly. If Uniswap goes rogue and decides they don't want me to use the retail interface.
From what I understand, ChatGPT writes code and the code works, but it gives the wrong answer a good fraction of the time.
That's a different discussion altogether, right?
Yeah, it's a different discussion altogether.
But you know, I mean, look, to your point, jump trading is probably one of the most sophisticated high frequency trading firms are quite active in this space. They've developed tools. One of them was their so-called wormhole tool, and that got exploited where somebody was able to steal from wormhole about $350 million in a time span of just 10 minutes. So, you know, even though you can be very sophisticated and clever in what you do, there's still possible attack vectors, right? As there are anywhere, by the way, right? So you have the same problem with any bank and any bank security system. Now, the one thing I will say is the assets themselves, when they're on the chain, they're very hard to steal because, you know, people would necessarily have to crack your private keys. And since that information that is on chain is not kept on a website, but on a decentralized database with, you know, tens of thousands of copies, I would say there's a much higher security level. So nothing has been stolen directly from Ethereum by hacking the blockchain or from the Bitcoin blockchain. I think that's quite important to note.
But you do raise an additional issue, which is if I were to do the trading, I would have to protect my own keys. So
Yes.
my security is only as good as my ability to protect the security of my own keys. Whereas if I, let's say, do business with Vanguard, I'm relying on Vanguard's keys. That's some sense.
Well, with great power comes great responsibility. So if you have your
Right.
own assets, use them to keep them in this wallets, and you need to have control. You are responsible for the control of it. That's just what it is, right? So if you have money in your wallet and if you have cash in your wallet, you're responsible for keeping that safe too. That's
Right,
just
so
it's a different
that-
framework, right?
Yeah, well, no, I'm just disputing slide number 1, which is that the decentralized exchanges are safer than trading on a regular exchange.
Safer in some sense.
So they offer safety, but the safety is just as good as the individual's ability to protect their own keys, which involves the individual's ability to secure their own computer and the individual's ability to verify that the auditor who's said that the website's not cheating them is actually correct.
Nobody's. Yeah, that's all correct. Carlos, you have raised your hands. Go ahead, just chime in.
Yeah, my humble apologies here, and this might be a very dumb question, so I apologize to the room as well. So my understanding is that the argument is the money that is sitting in the pool is not being probably remunerated accurately, if you will, based on some quantitative metrics. My question to you would be, should we be quantifying some kind of deterrence factor so that, say, having a very large pool deters, we'll call it, runs on a particular currency? And so these folks that just let their money sit there for an extended period of time that might not be remunerated, they should be remunerated more because they're almost like creating a sense of trust in the system as a whole. Is that kind of like a fair, logical argument from what you're saying, that, you know, these people sitting all that money there actually are an essential part of the system, and they should be getting some kind of a trust fee? Is that a fair way of putting it?
I think what you're saying is sort of like an adverse selection type of thing, where there is a run, when there is like a unidirectional flow, these guys end up holding the bag, and that's why they need to be compensated more, which they are to some extent with a higher fee. Whether that's enough or not, that's I think I'm ready to Andreas's first point, and that's something we can definitely look at. But you're right, because they're more passive, they're not updating very often. They tend to be they are likely to be on the losing side of this issue.
I guess my humble opinion is just that if you say it's low, it means that at some point you'd say it's too high. And so the net, would that be the price of trust?
It's a compensation for the adverse selection risk or for the run risk, however you want to label it.
You may want to separate the mechanism, the economic mechanism of the trading system from the trust questions around the safekeeping of the assets. I think a lot of the discussion was about that. But if I may say something quickly to Carlos's point, right? So if you look at the numbers, if you have, for instance, a 10% drop of prices or a 10% rise in prices for that matter, and you have a fee which is the higher fee, let's say, that is being compensated. And so if you look at, for instance, what happens in January of 2022 when prices in Ethereum dropped actually by that amount, if you looked at the trading volume that existed, and you look at the compensation and fees that people received for the trading, the loss that somebody had, the incremental loss from keeping the money in the pool was on the order of 10 basis points over a month. So it's obviously that's money, right? But it's it's a monthly holding horizon. So the numbers are actually not super stacked against your favor. You're not losing 20-30% relative to a buy and hold portfolio.
Thank you.
Sorry, I chimed probably in a little too much. Now we are already over noon. If there are any remaining questions left, then we're very happy to entertain them. Otherwise, I should let everybody go and enjoy the rest of their day. Any more questions? Well, then thank you again, Marius, for your great presentation. I just want to very briefly point out that we have another speaker in 2 weeks. That will be Maren Vallero from Northwestern, and she will talk about what type of transparency in OTC market. Well, the topic of the paper title is what type of transparency in OTC markets ? So we'll see you all hopefully in 2 weeks, and we're going to send out an announcement just a week before. Thank you, everybody.
Thanks for your comments. Thanks for having me.